David Conlon and Joanne Fisk from GCP Asset-Backed Income, who should be with us now.
Hi.
Hi both.
Hiya.
Brilliant. Thank you both for joining us today. Very excited to talk about the trust and talk about plans going forward. So should we kick off first with the presentation and then we can move into Q&A?
Yeah, that'd be great. Thank you. So thanks for taking the time to listen to us. We'll talk about GCP Asset-Backed Income, which we launched or IPO'd in 2015. So around about 7.5, coming up to 8-year track record now. GCP Asset-Backed Income is basically an investment company which focuses on debt, predominantly to UK businesses, though we do have sort of just over 20% of the money lent to businesses overseas. And what we're really looking to do with this is actually say we're an alternative lender, very much targeting, I think, the sort of 5 to 15 million pound loans, which we think actually offers good sort of value opportunities, in that it's they're too small for a lot of the larger players, and it's too big for a lot of the other sort of alternative lenders out there. And what that means is we think we can get a risk rating or a yield that's disproportionate to the risk that we're taking in these sectors. And what we're looking to do from this is obviously generate a strong and stable dividend to pay to investors. And so since IPO, we've actually managed to grow our dividend year on year. We're currently targeting a 6.325 dividend this year, which is up on last year. So we've been able to grow that year on year through the fact that the portfolio itself generates around an average of 8%. So we are typically as well cash covered on our dividend. Within that dividend as well, we do have quite a bit of inflation or interest rate protection as well, to ensure that we can try and make this attractive even in rising markets. And Joe will talk a bit more about how the inflation protection works and the interest rate protection we work has. The fund itself is around about 435 million, and we do have a RCF which we also use, and we've used that to currently have on our books around 62 different loans across 22 different sectors. So this is a highly diversified fund, and you can see sort of from the graphic there, we sort of batch each of these into sort of 4 main areas, and we'll talk about a couple of those later on that hopefully a bit of interest. But across those 4 areas, property, the large proportion of those sort of loans are in bridging loans. So this is typically someone who's bought a house or moved out of a house, doing up a house, and therefore just need a short-term loan. These loans are typically for under 1 year, and secured on a first ranking basis against the underlying property. We've also provided some money into buy-to-let mortgages through this sector as well, which has gone extremely well for us. In the asset finance, we have areas such as nurseries, children's nurseries, and football finance, so lending to Premier League or La Liga clubs. And we'll talk about those transactions in a bit. On energy and infrastructure, this is the smallest part of the portfolio now, and probably the one that we've seen the most churning recently, because this has obviously become quite a hot sector. But still, we have quite a number of loans out to sort of CNG, so lorries, fleets, which again have been a very good investment area for us. And finally, in social infrastructure, typically across this, we've lent into things like care homes, which are all operational now, one start actually development, student accommodation, being our sort of 2 big areas in these ones. So what we're really trying to achieve with this diversification is that there is no sort of correlation between the assets as well. So what might impact one asset, and we'll talk a bit about the 2 problem loans we've had, won't impact the other part of the portfolio. But equally, we're looking for areas where we think there's a real purpose or reason for that investment or that asset to be there. And that's a very key focus of why we lend into these companies. And I think you'd be able to look back and see the performance of the book through the pandemic, and if things go as people are expecting over the next year, we think this book is also very well placed to navigate pretty safely through the coming year as well. The team, so we've got a dedicated team to this fund at Gravis, as you expect, and we're obviously now very experienced, having been looking at this or looking after this fund for a good number of years now, and I've obviously been on it since IPO. The good thing about a debt fund is that money is constantly repaid and returned, and that's obviously we think a very good sign of a healthy debt fund as well, that we lend out money. Our average loan term is 5 years, and you can see from sort of the results last year, 135 million was returned, and we were able to redeploy that sort of 118 million back out. What we really try to do is we really try to focus on building strong relationships with the borrowers that we know and the sectors that we like. So in effect, we're churning deals into those areas that have actually performed very well for us in the past. Throughout the sort of 62 loans, we have 2 loans that sort of currently we class as a problem loan. One of those actually though is fairly small and actually fairly close to getting worked out, and then we've got sort of a larger problem loan which we'll talk about in a bit more detail. And then finally, we continue to see a very strong pipeline and good opportunities for reinvestment. Banks again are slowing down, and that's the time for sort of alternative lending funds such as us to I think really have the opportunity to take advantage of that in sort of uncertain market conditions. The actual opportunities and the rates of return and the risk that we take will all get better for us. So we expect to actually have a very good year going forward. So what do we look for when we're sort of investing? This is really important. As I said, we really want to have a protected investment. So we want that physical asset or contracted cash flow. And by physical asset, typically we've got quite a lot of buildings within this, or sort of so something that we can actually grab and take hold of if we need. Or contracted cash flows, in effect, when we're looking at contracted cash flows, we're very much looking at cash flows which we are fairly certain will be there. So, examples of contracted cash flows are long-term O&M contracts against rooftop solar that we've got, or management fee contracts for funds which are irredeemable. So, you can actually be pretty certain that those assets are there because or cash flows will be there because the assets are already there. The performance has been proven, they're easy to do, and therefore we can get certainty there. We also, but as well as the assets that we really focus on, we also really want to understand the borrowers and their know-how. And I think this is, one of the key things that differentiates us from a lot of other lenders is that, we probably put as much weighting into who the borrowers are, what their knowledge is, what their track record is, how they come across, how they respond, how they interact, how they treat their staff. We put as much effort into that and finding out about that as we do equally about the asset as well, because we find that bad borrowers will cause an impairment to your asset, and you don't. Therefore, you really want to ensure that you're lending to the right people who know what they're doing, and therefore building a good relationship with them so that you do have the optimal chance to get your money back. And finally, how we operate is we are very much a project finance lender. What that means is we typically will lend to a straight SPV, which or special purpose vehicle, which has the sole purpose of holding that asset or cash flow, and therefore we can take control of that when we need to be. So what we do there is, we have very heavy upfront due diligence, loan negotiation to go into that, and therefore we get extensive security packages. But equally, we ensure that we lock those in as well. So we have lots of non-call periods to ensure that people, we don't go through all that time and effort to have our money repaid quickly. So, that's sort of the key underlying factors that we really look for. And then, you know, this is regarding sort of the first quarter. So unfortunately, we're sort of in that period now where we've just obviously finished the second quarter, but we haven't been able to release the NAV or the quarterly statement. But you can see there, you know, the first half of this year very much continued, or first quarter of this year very much continued like last year. You know, we continue to get money back, which obviously we think is a good thing. We continue to be able to actually deploy that money back into attractive sectors. We say that we kept up the asset classes, and the loans outstanding, actually that increased to 62 in the period from 60. So again, just further diversifying this portfolio, even though we're obviously having loans repaying. We continue to meet our dividend targets, and actually, you know, as I said, we generated cash in excess of that, so we were cash covered on the dividend in the period as well, which is obviously very key. And again, you know, sort of portfolio and inflation rate protection, obviously the hot topic on everyone's mind at the moment, being where it is. And again, you can see that actually there's good protection within this portfolio on that. But equally, I think it's important to know that, you know, that there's obviously 54% of the portfolio without that protection. But we're very comfortable with that, because actually that's typically the shorter dated loans, so the principal being repaid. Therefore, we're actually able to sort of lend that back out at sort of the current market rate. So, you know, actually having the money being returned to us and coming back also adds an element of inflation and rate protection, because we're then able to adjust the rates that we lend that money out to. So what we're, you know, ideally targeting here is that we can always maintain a attractive dividend that sort of will beat inflation over a period of, or a longer period of time. And before I get sort of, or before I hand over to Joe to take you through a few more slides, we do have one default, or one key defaulted loan in the portfolio, and this defaulted at the beginning of last year, and we're currently trying to work this loan out. So the collective was a co-living operator. So this is their Canary Wharf building that we funded. So they were a party, and we entered into a loan with them alongside a sort of a large investment bank, as sort of a club or syndicate of lenders. The idea being that they would sort of, and unfortunately this loan was originated shortly before COVID struck. The idea was that they would continue to build out buildings like this. They had a number of sites secured across the UK, US and Germany. They would build out these sites with the increases of value that come from them, and that would secure our loan. This was the only sort of more corporate type loan we've ever done. So this was more at the holdco level than directly into the asset level. And what we were doing was in effect funding the sort of part of the equity going down, but equally secured against the equity in the assets that they had already built, or the land bank they had built up. The assets themselves, the operational ones, are performing very well still. So Canary Wharf there, I was there yesterday actually, is pretty much completely full. It consists of long stay and short stay. The short stay had its best ever month in July, doing well. Old Oak as well, the other large asset, is also performing very well, about 95% full. So Canary Wharf's about 97% full. So the concept is working well. Rents are going up as you'd expect. So in these times where, you know, rents are getting higher in London. So the assets themselves operationally continue to perform well. We've actually realised 10 of the assets that came across as part of, or we took security over out of the 22 assets that were in the group. And we continue to, we realised 12, we have 10 assets that we're currently working through, and we're expecting to hopefully be able to resolve pretty much all of those during this quarter. We've got brokers appointed on a number of the assets, and are in active discussions on sales on a number of the others. As equally, we are speaking to some of the other sort of co-investors about buying out the stakes. So all of that continues to move as we'd hope. We've had a number of realizations to date. We've had a number of realizations to date, and money is now starting to flow back from those as well. Overall, though, I suppose the current macroeconomic climate probably isn't helping. You know, the cost of borrowing has gone up, certainly at the sort of lower scales. And people are also looking at the sort of the net yields that you buy buildings like this on, and so, you know, determining whether they are sort of rising or not, or indeed some larger buyers are sitting on their hands at the moment. So, you know, this continues to be a challenge for us, and it continues to be one that we're working extremely hard to resolve. But again, I should note that this is the only loan like this the portfolio has had. All the other loans are at the asset level, so I would be directly lent against this building. You know, one thing I would stress on that is, although sort of our loan in this sector or this company hasn't gone great, in effect the asset level loans, where say all of the other loans that we've originated are at, not a single one of those has lost any money. And you know, Gabby going forward will ensure that we do not move away from that again. Now hand over to Jo to talk about some more fun things.
Thank you. So we have a few case studies on two different sectors that we're lending to currently in the portfolio, and then I can run through a little bit about how we're approaching ESG, and a bit more, as David mentioned, on the inflation protection within the portfolio. So to start, football finance is a relatively new sector for the fund. We made our first investment about 2 years ago into this sector. Excuse me. And it is one of the more sort of unusual sectors that we have within the kind of asset finance section of the portfolio. So we became interested in this sector and spent sort of a good time researching the kind of market, and this has actually become a very good source of pipeline deals for us, at its peak representing around 10% of the portfolio. But obviously that changes with repayments, and these loans are relatively short dated, as I'll explain. So this slide details our first loan in that sector. So this was a participation from a larger lender, one of the leading banks that operate in this space, where we took 10 million euros of a 30 million euro financing for a Spanish club secured against their media rights. So the way that these loans are structured is that within those Spanish leagues, the league will have broadcasting contracts with the sort of key broadcasters, and they have fixed under certain regulations the way in which participating clubs will get paid through those broadcasting contracts. So the formula under which their sort of amounts are paid to them takes into account quite a number of different elements, including the kind of size of the clubs, the ticket revenue, how well obviously they're doing in terms of sporting performance. So using that formula, which is set out in the regulations, we can work out the sort of minimum payment that club will receive, and that's set out in quite a fixed schedule under those regulations. So we're not taking a risk on the kind of sporting performance of that club. We're looking at the sort of minimum base level performance and working out what those sort of contracted revenues will be, and then securing the debt against those. And under this structure, the payments are made directly from the league to the lender, which is then passed on to us as the kind of sub-participant. And the thing that we think is quite interesting about this is that we're also able to, if there's a relegation of that club, so if they perform badly, we're able to accelerate those payments, as is kind of shown in this graph at the bottom here, to make sure that that's always matched to the payments that they're receiving, and that there isn't ever a mismatch between the broadcasting revenue that club is receiving and the sort of debt payments that they need to make. So the benefits that we think of this kind of structure is that we have strong counterparties that we're engaging with, so particularly with the leagues. We have kind of regulated and predictable cash flows that we can secure the debt against. And in this case, we've seen here this loan repaid in full ahead of their sort of amortization profile, with an early prepayment fee, which sort of boosts the returns for us. So this was our first loan in that sector, and as I've said, we've done a number, around 6 of them since, to a sort of range of clubs, so UK Premier League clubs, and then the equivalent for sort of Spanish and Italian clubs as well. So a sector that we really like, and sort of continuing to see interesting deals in this area as well. And our second case study was obviously a very different sector, with student accommodation, which, as David said, made up a significant sort of proportion of our social infrastructure within the portfolio. So this asset is a student accommodation asset, 298-bed project in central Dublin. And as you can see from the key terms that we set out there, this was a mezzanine loan, so where we're sitting behind the senior development lender, and one of the higher margin loans within the facility at 9.5%. And that really reflects the kind of additional risk of it being a mezzanine loan and also having the construction risk. And as we've set out in the slide, this was a complicated development really. It had to fit within very much in the city centre of Dublin. Had obviously the construction risk, which, as we know, has been slightly more complicated over the last few years, and particularly as this construction was taking place during the sort of COVID pandemic. And there was architectural significance on the site, which meant that there was sort of further complications in how that could be developed. So, as I say, this kind of is reflected in the sort of higher margin that we have on this loan. But actually, we, from our perspective, thought that there were very significant mitigants to this. So, not least that the debt coverage on this would be met at 67% occupancy, when historically, and in fact on this project as well, occupancy has been in the high 90s, if not sort of completely full for these projects where we funded them in the past. And also, as David mentioned earlier, one of the things that we spend a lot of time looking at is the developer and the borrower under our loans. And we know that the team that were behind this project had very significant experience. They were working with good counterparties in terms of their build contractors and their planning advisors, for example. So that really mitigated the kind of construction risk on the project. And in fact, they were able to finish the project, built to time and to budget, and they're sort of working through their operations now, going into a high demand season, obviously with the new academic year starting in September. So this loan was for £18 million, as I said, on a mezzanine basis, rolling up, capitalising through that development period up to 24 million. And we have received 50% prepayment now that the asset's in operations. And our expectation is that the borrower will refinance or sell this asset later this year, given the kind of really strong performance that they're getting there, and the high demand in the market for this kind of project. And that, with the repayments and the pay downs, will give us a return probably likely of over 10% on this loan, which we think represents a really good risk return, given the mitigants that I kind of outlined on that. So moving on briefly to talk about ESG before I just briefly touch on inflation, and then we'll kind of wrap up. So on the ESG, obviously this is an area of focus for us, for the board, and obviously for lots of our investors. And we've taken perhaps a slightly different approach to some of our peers, in that we're not looking to kind of rank our assets, or we're not looking to change fundamentally our investment objective, but we're kind of recognising our position of influence as a lender to the kind of projects that we have in the portfolio, and using kind of mechanisms where we can to use that influence to promote change. So we have got an ESG policy, and our annual report kind of expanded the sort of sustainability section to discuss some of the policy points and the progress that we made over the last year, as well as setting out some kind of targets and objectives for the coming year, which we're working through at the moment. And as I said, you know, using our influence as a lender to projects, one of the key policy ideas that we have, and which we're working through at the moment, is looking to use incentive schemes to encourage different behaviour within our borrower companies. The way that we're doing this is looking at agency fees, which we would charge basically for sort of administration of the loans to borrowers, which range between about £5,000 to £20,000 per year on the loans, and seeing if we can apply those funds in different ways, so that if our borrowers achieve certain targets or use those funds to set up different schemes, that we will waive the fee for them. So we currently have 4 schemes in progress, which are nursery places, so sponsorship schemes for underprivileged children to access high quality nursery provision. Rooms for refugees, so where we've allocated co-living rooms for people fleeing conflict in Ukraine. Studio scheme, which is subsidised studio spaces within our community facilities. And then lastly, a new scheme which we're looking at working with local young people in partnership to one of our residential development borrowers to allow for dedicated music studio time for local people within that area. So these are the kind of schemes that we're looking at the moment. We're hoping to sort of progress these further and report back to investors on those shortly. Within the kind of ESG mandate, we're also carrying out climate risk analysis on the portfolio and seeing whether any of our borrowers need support, for example, in improving their EPC ratings or their flood risk assessments on their projects. And as I said, we have a policy plan, and there is a board member now responsible for ESG who's been appointed to sort of drive this forward. As ever on this, we're definitely open to feedback from investors on whether this kind of fits with what they would be expecting for us to do and whether there's any sort of improvements we can make. So we're reaching out to investors as well to understand how they feel about the kind of approach we're taking. So to talk briefly about the sort of inflation protections and rate protections within the portfolio, as David mentioned, this graph I think brings out quite clearly, this sort of sets out the repayment profile currently of the portfolio and shows that we have a weighted average life of around 5 years. So as David said, this allows for sort of reinvestment. And as we've kind of flagged up earlier, there is inflation protection on just under half of the portfolio. And this pie chart really tries to bring out the different ways in which we have that protection within the portfolio. So just to run through quickly, so 16% of the portfolio has direct rate linkage. So that's where there's a direct change in the rate when there's increases in rates. Principal indexation, where the principal was increased based on increases above a sort of threshold base rate. And typically for those two elements, we're looking at longer term assets where there is a long-term loan and also their income has some inherent kind of rate protection in there, so that they're kind of protected and it's an appropriate change in the loan terms for them. We also have profit sharing, which is on around 18% of the portfolio. Oh, sorry, around 12% of the portfolio. So that can be in the shape of sort of warrants or exit fees, and that can be in a number of different ways. But again, that kind of protects us in that way. But then, as David said, we think we've been sort of reporting this 46% number throughout a lot of our literature, and it doesn't really tell the whole picture. So hopefully this brings out a bit more clearly that of the 54% remaining, 49% of the portfolio, whilst it's fixed rate, it is under 3 years remaining. So that does give us the opportunity to reinvest at prevailing rates. And we are focusing the inflation protection, there's different mechanisms that we have on those longer weighted terms, so that kind of gives us the protection over the longer term. So, you know, we're very aware of the kind of inflation and interest rate environment at the moment, and we think that we're really well placed as a portfolio to respond to that very well. And just lastly, before we kind of conclude on our presentation, one of the kind of elements that we really focus on and we think shows the kind of healthy life of the debt fund is the repayments and reinvestments that we generally have in each quarter. And I think Q1 this year, which is reflected here, was a really good example of that. So we had £32 million in repayments through a number of different projects. So firstly, the football finance loan that I talked through in the case study. Then we had partial prepayments on student accommodation projects, including, again, the second case study that we had there. And then obviously we have the amortization of the normal loans, the normal amortization of the loans coming through. So, for example, in that quarter, that was across nursery projects, property development loans, other football finance projects, and CNG stations. So altogether, those repayments came to just over 32 million. And within that same quarter, we were able to reinvest into new projects. So we had 21.7 million in new projects across 6 different sectors, sort of diversifying further the portfolio. So again, new football financing, new property loans, and further drawdowns for projects that we were already involved with. And I think this shows quite a healthy kind of churn across the portfolio, and something that we're really trying to bring out and show that we've got a good churn across that portfolio as we move through, and a good pipeline moving forward.
Brilliant, thank you, Jo, and David for your presentation. They're really interesting investment opportunities there. And we've actually got a few questions about those. On the mezzanine debt, how do you source those opportunities, and what sort of interest rates are you able to achieve on the mezzanine debt?
We source just a lot of them through sort of market contacts, people coming or approaching us, or indeed existing borrowers that we've previously done deals with, hopefully doing further deals. In terms of rates, the mezzanine is probably sort of between the 8 and 10% is typically where we are. So on the student accommodation, we will typically get around about 9.5% on our mezzanine debt to those. So yeah, it's sort of a good mix, but certainly slightly higher. But equally, we're comfortable on those. As Jo sort of talked through on the case study of Dublin, the loan to value, even including the mezzanine debt, is in the 60%. So there's a huge amount of coverage at that level, with banks sort of taking a more conservative approach, and I think that's really opens an opportunity for us. And indeed, I think going forward, as banks again might get more conservative, there might continue to be more mezzanine opportunities for us again, which we like, and I think we're close to the asset and know the developer would certainly like to do more.
Great, thank you. What other sorts of assets are you financing within the sort of social infrastructure space?
So across the social infrastructure space, we've got the nursery projects. So as we mentioned, they're kind of children's nurseries, and we've funded a number of development and now operational projects in that space. And they've actually performed really well sort of during the pandemic, as people have that as a sort of primary payment that they would make to ensure sort of childcare. We also have care homes, which, as David mentioned, we've worked with them through development and now in operations, and now we've just in the last 6 months funded a new development project in Wales for a sort of bespoke high-end care home offering. And then we also have in that space supported living, and also a recent project that we did in the last year for airspace development for social housing in South London. So it is quite a mix in the social infrastructure space.
And are there still plans to bring the co-living REIT to market, or is that just sort of dead in the water?
Yeah, I think unfortunately timing and sort of the timing of the co-living REIT, sort of due to occur 4 days after the Ukraine war, and I think the market is still probably dead for IPO. So we're looking at alternative ways to divest those opportunities now. Sure,
thank you. And we've got a question on the La Liga payments. Is there any risk to these?
No, so the broadcasting contracts that we're secured against, we're not taking any risk on the writing of future contracts. So we're looking at the contracts that are already in place. In fact, the reason that this loan repaid is that La Liga signed a deal to sell a portion of those broadcasting contracts, which then sort of triggered a repayment on our loan, but certainly didn't present any kind of risk to those payments being received. Historically, there was, I guess, a kind of rebate for COVID matches that didn't happen, but that was before our loan was written, so it didn't present any kind of risk to our payments at all.
Sure. What's the typical life of the debt in the portfolio?
So across the whole portfolio, the sort of weighted average life is just over 5 years currently, and the range, I suppose, on that is between maybe 1 year to sort of around 20 years currently.
And do you face, is there any sort of competition for loans? Like, do you get involved in competitive bidding sort of processes?
So we typically don't get involved in competitive bidding because we like to know the borrowers, as we've said, and sort of speaking through agents and trying to match the terms that probably best suit the agent as opposed to the asset is something that we don't really get involved in. So yeah, we tend to rely on reputation, word of mouth, recommendations for our borrowers, or equally, like Joe did with the football, we see a sector that we think is quite interesting, and we go off and speak to people, lawyers, other investors in that sector, and build up some market knowledge before deciding to invest or working out a way to invest, and finding the key parties that we can speak to. So yeah, so we tend to prefer to do it that way than getting involved in broking. Pretty confident I can say, over the 100 loans that we've originated, and I think we've originated coming up to £1 billion now with Gabby, with all the recycling of the money. I don't think we've entered a single bid or competitive process.
Sure, thank you. Another question, presumably your borrowers are unrated. However, if they were rated, what do you think the average credit rating of the portfolio would be?
I must admit, I don't think I'd be competent to ask on that. Our borrowers are all rated, and therefore we don't get a rating. Actually, the only rating we have had is our buy-to-let mortgages, where actually part of our loan, even though it was mezzanine, was in the AAA or AA proportion of that loan. But yeah, so that's not a sector of the market that I particularly know how to answer.
Sure. Do you think you might allocate more to co-living type investments going forward?
Yeah, obviously co-living it's been pretty awful, obviously, but also it's been interesting. And I think what we've seen is actually the sector itself. The sector call, I think we got right. The co-living buildings, the opportunities are very good, and I think those buildings and that sector is going to do very well in the years to come. So we've certainly not been put off the sector. I think we will be like we do a student. We will stay much closer to the asset, but I think we like the sector, and we've seen it perform very well. And we've got very first-hand experience of seeing how that sector performs. So certainly when we put off the sector, but yeah, we certainly wouldn't structure it the same way as we did on that loan.
And are there any other areas that you've maybe not looked at before that you're thinking about, or maybe want to look at a bit more closely in the future?
Yeah, so Joe mentioned the social housing deal we did. We think that's actually quite interesting. It's hard to do because in effect you're putting new housing above existing blocks of flat. Therefore, there's quite a lot of residential or resident issues to sort out. Keeping local authorities. But we actually think that's going to be quite an interesting play for local authorities, especially sort of central London ones where they've got real issues with land banks. That I think is a really, or a sector we certainly like to do quite a bit more in. And the ones we've got have got sort of agreements in place where the local authority will buy 100% of the product at financial close with a senior. We've got the GLA, so Greater London Authority is the mezzanine lender behind us. So yeah, we'd like to do more there. The CNG trucks would like to do more. So we've got sort of about £7-8 million outstanding with them. We'd definitely like to do more in that. So I'm not sure we have any particular new stuff, but there are areas of the portfolio where we're actually very happy with it, and we'd like to increase our exposure. Sure.
Just another question: do you or would you fund assets like telephone towers?
Probably not, because either I think they would be too low yielding for us if they're a good one, or if they weren't too low yielding for us, there'd probably be something wrong with them. So I think that's a market that's probably beyond us, or wouldn't be, or too much of a risk for us.
Sure. What is your average LTV and by sector?
So I think in the property sector we average about 62% loan to value. obviously you can't really apply LTVs across the asset-backed and the infra ones because they tend to be done on cash flows, and then on the social, again, we're probably sort of in the high 60s on those.
Thank you. What sort of covenants do you put into your loans?
So all of our loans, we sort of look at them on a bespoke basis. So it would really depend on the asset, the sector, and the kind of deal that we were looking at. So as you've mentioned, on the kind of property side, we would look at loan to value covenants. When we're looking at construction loans, obviously we have a much stricter kind of suite of covenants that we would look to include there, so that we can monitor the construction as it goes through and make sure that payments are used appropriately. And the financial covenants on a kind of cash flow deal would look at interest cover ratio. If it was amortizing, we'd look at debt service cover ratio, loan life cover ratio. So it can really vary between the different assets and the sectors, but we'd always look at the kind of underlying fundamentals of that business and make sure that we were matching the covenants appropriately to be able to monitor and get sort of warning of any issues that were coming up on those.
Sure. And with the current rising inflation and interest rate environment, are there any asset classes that are probably better opportunities than others at the moment? And if so, which ones?
Yeah, we're probably seeing, I think there's going to be quite a property, I think will probably prove to be quite an interesting sector coming forward. I think there needs to be a bit of a rethink about how people finance that. So typically, you know, us and everybody else would look to put in place an EPC with price certainty with a builder. You know, 2-year contract, builder takes all the price and the risk of delivering that building to you at the end. I think there's going to be a real move away from that now, because builders, you know, with their margins being what they are, can't take, you know, inflation risk to the extent that they historically did. So I think there's going to have to be quite a bit of rethinking about how you get yourself comfortable with that. And I think funds like ours are able to do that thinking and quicker than other parties. So I think that will be an interesting space for us, and you know, people will probably leave that space while they're trying to work that out. So I think, yeah, property will be quite interesting for us, I think, over the coming year.
Great, thank you. How many assets have you needed to take control of so far, and what sort of resources do you have to manage such assets?
So we've only had to take the co-living control of the co-living assets. So we've done over 100+ loans now, so it was just that one. Yeah, in terms of resources, we've also got the whole of Gravis here. We've got various experience across the other debt fund that we've done. We're also able to bring in resources as required. So you know, we've got experience now of working out, and a team and a company with enough people available as well to help out as required.
Do you make loans to assets held by other Gravis funds?
No.
Thank you. What's the duration of the portfolio?
5 years. So the average life of the portfolio is 5 years. But as I say, we've got stuff that's coming back in the next few weeks to loans that are outstanding for the next 20 years.
Is there any overlap at all with GCP infrastructure?
Yes, historically, no. So GCP infrastructure has a very narrow remit, so it can only really do, it was only able to do loans backed by sort of or the UK government. And in effect, Gabby was set up to take advantage of the opportunities that GCP infrastructure couldn't do. So yeah, we've never had any sort of blurring of the lines between the two. We've always been able to both work out which fund it sits into.
Which other funds in the sector would you consider your sort of biggest competitors, and how would you differentiate yourself?
Yeah, well, obviously the debt funds have, you know, on a whole, I don't think has been, you know, hugely successful. Obviously, when we first started, we were very much compared to SQN at the time. That and, you know, Hadrian's Wall, I suppose, was the other one who launched around about the same time as us. Obviously, both of those are now, or Hadrian's Wall has been sold and SQN's in realisation. RM, direct lending, Starwood as well. You know, of all of them, I think we're probably the closest to Starwood in that it's more property focused lending, but there's not really, you know, certainly there's not as many of us around, and you know, I think even in the unlisted space, you know, you're probably looking at, you know, the likes of Puma or, you know, Investec on some deals that we're more aligned to.
What sort of assets are in the energy and infrastructure part, such as sort of wind, solar, battery storage?
Yeah, so for us in that space, we did have some battery storage projects, but they've all repaid now. So we thought that was going to be perhaps a bigger kind of sector for us, but it moved away from us a bit more quickly than perhaps we'd expected. So we don't have any battery storage left in there, but we do have the CNG stations. And we have exposure to kind of other sort of energy renewable infrastructure. And then, as David mentioned, the sort of contracted cash flows for O&M contracts relating to solar panels as well that we have in that space.
Brilliant. Can you talk a bit about the gearing on the trust?
Yeah, so we've got an RCF of £50 million. Actually, we're currently not drawn at all on that. So, but we've got a number of deals that we're expecting to complete over the coming weeks that will allow us to move into that RCF. I think historically, over the last year, we sort of averaged about 30 to 40% drawn on our RCF, which would, you know, equate to, you know, 15 to 20 million. So in terms of gearing, you know, we probably run about, you know, 5% on average.
Brilliant. You've got quite a lot of diversification in the portfolio at the moment. How big is the pipeline?
Yeah, so we have, I think, probably about 40 to 45 million in the pipeline currently. Obviously, it sort of changes quite quickly as deals come through and close as well. So we've had quite a quiet Q2 with sort of delays on a couple of projects, but I think that means that Q3 will be much busier with the number of deals closing out in the next couple of weeks, as David mentioned.
Sure. Also, the trust has a very attractive dividend at sort of over 6%. How was that impacted by COVID, if at all? And what's the sort of plans going forward?
Yeah, no, we on a cash basis, we covered our dividend fully during COVID. The only problem loan we had, was the co-living loan. Everyone else paid in full and on time. So or as expected. So yeah, actually the cash and the cash position has been good. I think in the first year of COVID, we were able to pay out a special dividend. We didn't pay that last year, but yeah, the dividend remains strong. As I say, in Q1, you know, we generated, or the NAV slightly increased as a result of cash generation. You know, one thing we've never done with this trust is we don't value up our loans. We tend to just hold them at par and only value them down. I think there's two exceptions to that, where the loans are performing so well that the valuers did move them up. But our stated aim is that we will typically always try and hold our loans at par, and hence, you know, the movements you see will be as a result of the cash we generate.
Sure, thank you. Have you benefited from rising power prices at all?
No, we don't have any loans that, well, only through cover ratios, sorry. So we have, so on the solar O&M loans that we've done, the cover ratios have obviously got a lot higher, but it doesn't flow through to the debt. So there's no benefit there for us.
Mm. And how much of the portfolio turns over in a typical year?
So we're seeing about 25% of the portfolio turning over in a year now, or 20 to 25%. So it's pretty healthy turnover.
Has that changed over recent years?
Yeah, obviously it takes a while to get to that. So, you know, as Joseph now, you know, half our loans are now under 3 years. And so it's just that constant, you know, sort of the work we did 2 or 3 years ago is now starting to repay. You know, the student development in Dublin, you know, we funded that from the start, and that's now getting to the stage where, you know, those assets will be sold. So obviously over time that has built up. You know, I think the first year we just had the amortization back. So we'd expect it to be pretty consistent now that we do get, you know, 20-25% of the portfolio back on any given year.
Sure. Do you think that might change as interest rates rise?
In terms of, I suppose, you know, we certainly haven't been asked to date for any extensions of loans or borrowers looking to redraw. You know, yeah, there obviously is the potential if people decide that you know, now may not be an opportune time to sell or change their plans slightly. They may look to ask us to extend the loans, but yeah, we haven't seen evidence of that yet. We're still getting back, you know, back the money very, very regularly.
Sure. Are there any equity-like exposures in the portfolio?
Only now, I suppose, the co-living loan. Everything else is still very much debt-like. We don't have any equity-like exposures. And again, as I say, you know, you can see that through our NAV, and the fact it's very consistent and doesn't, and only really moves via cash generation.
Sure, thank you. I think we've got time for one last question. Are you guys invested in the trust yourself?
Yeah, very heavily. So it's my largest single investment.
And yes, also for me.
Brilliant. Good to see skin in the game. Thank you very much for your time. Really interesting presentation, and yeah, lots of interesting opportunities there. Yeah, thank you for joining us, and thank you to all our viewers that joined us as well today. I'll just put up the list of our upcoming shows. So next week we have Jennifer Myrna from Aberdeen Diversified Income and Growth. The following week, Phil Kent from GCP Infrastructure, and on the 29th of July, Ian Hargreaves and Fiona Yang from Invesco Asia, and we will also be joined by Andrew McCarthy. So thank you guys for joining us, and thank you to all our viewers, and have a good weekend.